Section 2.3. How exchange rates are quoted. Page 1. In the FX market, when you see a currency pair like euro/US dollar, euro to US dollar, equals 1.1500, that quote means 1 unit of the base currency euro costs 1.15 quote currency USD. This is the standard way of expressing exchange rates in most platforms. Turn 0 search 12. The notion of base and quote currency is fundamental, but the way the number is quoted, directly or indirectly, varies by convention and the perspective of the party quoting. A direct quote from a domestic perspective expresses how much domestic currency is needed to buy 1 unit of foreign currency. For example, for someone in the U.S., euro to US dollar equals 1.15 is a direct quote. You need $1.15 to buy 1 euro. In contrast, an indirect quote expresses how much foreign currency you need to buy 1 unit of your domestic currency. In the same example, US dollar to euro equals 0.87, the reciprocal of 1.15, would be an indirect quote for AUS. Understanding which form your broker or platform uses is critical because changes in the quote direction can flip your interpretation of currency moves. For example, in a direct quote, a lower number implies your domestic currency has strengthened. You need fewer units to buy 1 foreign currency, whereas in an indirect quote, the interpretation is a reverse. In many major currency pairs, the U.S. dollar is involved, and conventions have developed. For example, many quotes show USD as the base currency in certain locales, termed European terms, or USD as the quote currency, American terms, depending on region and instrument. These conventions affect how you read the chart and interpret currency's strength/weakness. Thus, becoming fluent in quoting convention is crucial. Before opening a trade, always check how your platform displays the rate, whether the quote is direct or indirect for your account currency, and how a move in the number affects value in your account currency. We'll next explore how bid/ask spread and cross rates build on this quoting foundation. Page 2. The quoting conventions extend beyond direct and indirect to American and European terms, particularly when one of the currencies is the U.S. dollar. According to the CME Group Educational Guide, American terms means the U.S. dollar is in the quote second position, e.g., euro to US dollar, whereas European terms places USD first, e.g., US dollar to Swiss franc, when quoted from the perspective of a non-U.S. resident. Beyond region, it is vital to understand cross rates. A cross rate is a quotation of 2 non-USD currencies, e.g. euro to pound sterling, which can be derived via USD pairs. For instance, if euro to US dollar equals 1.1500 and pound sterling to US dollar equals 1.3000, then euro to pound sterling is almost equal to 1.1500 divided by 1.3000 almost equals 0.8846. Traders use cross rates for diversification, and when USD pairs are less favorable, the quoting mechanics remain the same: base/quote notation, interpretation of movement, and the underlying currency relationship. Regarding bid-ask spreads, your broker presents 2 numbers: the bid, what you can sell at, and the ask, what you can buy at. Exchange rate quoting conventions mean the same number movement might be read differently in direct versus indirect quote setup. For example, in a direct quote, a drop from 1.1500 to 1.1400 suggests your base currency strengthened. In an indirect setup, the same drop might suggest the opposite. It's important to internalize how your platform displays quotes to avoid misreading moves. Finally, consider the account currency matter. If your trading account is in a currency different from a quote currency, every move in the quoted rate may have an additional conversion step when translating profit/loss into your account-based currency. Quoting conventions thus have a knock-on effect on how you plan trade size, stop-loss levels, and profit targets. Understanding how and where the number sits ensures you interpret rates correctly before you trade. Page 3. Another critical dimension of quoting is the concept of reciprocal rates. Every direct quote has an indirect counterpart. Using the example euro to US dollar equals 1.1500, 1 euro costs 1 US dollar and 15 cents. The reciprocal US dollar to euro equals 1 divided by 1.1500, almost equals 0.8696, means 1 US dollar by 0.8696 euros. Some platforms display only one of these. Others provide both or allow you to toggle. Recognizing that one implies the other helps you switch perspective as needed. It's also essential to know how price movement translates into appreciation versus depreciation. In a direct quote scenario, domestic currency base, a falling rate means a domestic currency is strengthening. You need fewer of it to buy a foreign currency. In an indirect quote scenario, a falling rate means a domestic currency is weakening. You get fewer foreign currency units per domestic unit. Misinterpreting this can lead to incorrect trade assumptions. For instance, if US dollar to Japanese yen shifts from 110.00 to 108.00, assuming USD is base, that indicates the US dollar is weakening relative to yen. You need fewer dollars per yen now. If your account is in US dollars, your profit/loss calculation must factor in that movement magnitude, the lot size, and the pip value, each of which depends on how the quote is structured. Moreover, some quotes are shown in pips, the standardized smallest price move, or pipettes, tenths of a pip. The quoting convention, base/quote currency, decimal places, influences how you compute value per pip, trailing stops, and break-even levels. Before you open your next trade, check your platform to identify the quote type, verify which currency is base/quote, and practice converting reciprocal rates. By doing so, you'll reduce the risk of reading the chart backwards and place yourself in a position of clarity rather than confusion. Page 4. Bringing it all together, quoting convention affects much more than how you read a rate. It impacts execution, risk management, and profit/loss calculation. Let's walk through a practical scenario. Your account is denominated in US dollars, and you trade the pair Australian dollar to Japanese yen, Australian dollar versus Japanese yen. On your platform, you see Australian dollar to Japanese yen quoted as 93.40. That means 1 Australian dollar is worth 93.40 Japanese yen, JPY. Because your account is in USD, you must compute how that movement, say from 93.40 to 93.80, translates into your USD account. That involves pip value in JPY, conversion of JPY to USD at the prevailing rate, and any broker fees. Further, if your broker shows US dollar to Japanese yen rather than Japanese yen to US dollar, you need to reverse the quote to align it with your base/quote logic, or use the reciprocal. Without clarity, you may misassess your risk or stop-loss size. Best practice: always check the quote notation, and if your home/denomination currency isn't in the quote, do the conversion math beforehand. In summary, quoting convention is not academic. It's practical. You must know 1. Which currency is base and which is quote. 2. Whether the quote is direct or indirect from your domestic perspective. 3. Whether the quote is consistent with your account currency or conversion is needed. 4. How pip value and lot size interplay with your denomination and the quote currency. With this understanding of how exchange rates are quoted, you're ready to explore the mechanics of spreads, leverage, margin, and position sizing in Section 2.4. That section will show you how quoting, cost, and risk work together in live trading. Section 2.4. Spreads, pips, and leverage. Page 1. In the world of Forex trading, three critical mechanics underpin how you engage the market: spreads, pips, and leverage. Mastery of these is key to both execution quality and risk control. Let's start with spreads. A broker quotes two prices for any currency pair: the bid, what you could sell at, and the ask, what you would pay. The difference between them is the spread, essentially the cost built into your trade at the outset. For example, if euro to US dollar is quoted at 1.1000/1.1002, the spread is 0.0002 of the quote currency, 2 pips in this case. That cost must be overcome for your trade to become profitable. The spread reflects the broker's margin, liquidity of that pair, and underlying risk in the market. Spreads aren't constant. During times of low liquidity, high volatility, or major news announcements, spreads widen, meaning your cost of entry rises. From a beginner's perspective, choosing currency pairs and brokers with consistently tight spreads is a practical way to reduce friction and focus more on strategy than cost. Major pairs during major session hours typically offer the best spreads. Page 2. Next, let's examine pips, the smallest standardized unit of movement in a currency quote. The term pip stands for percentage in point. Typically, for pairs quoted to 4 decimal places, 1 pip equals 0.0001. For example, euro to US dollar moving from 1.1050 to 1.1051 is 1 pip. For Japanese yen currency pairs, because they use 2 decimal places, 1 pip often equals 0.01. Understanding pip value is important because it ties directly to profit, loss, and position sizing. For example, in euro to US dollar, a change of 1 pip on a standard lot, 100,000 units, might be worth roughly $10, assuming USD is a quote currency, though exact value depends on pair and your account currency. From a practical standpoint, tracking moves in pips helps you evaluate cost, spread in pips, risk, stop loss in pips, and reward, target in pips. For example, if you buy euro to US dollar at 1.1050 with a 20 pip stop and 40 pip target, you're risking 20 pips to gain 40 pips. A 1-to-2 risk-reward ratio. Realizing this, tighter spreads, fewer pips costs, plus consistent pip-based risk control equals better mechanical discipline for your trades. Page 3. Now we layer in leverage, arguably one of the most potent and dangerous features of Forex trading. Leverage allows you to control a large position value with a comparatively small amount of capital margin. For example, a leverage ratio of 100-to-1 means you could control $100,000 in currency for every $1,000 of your own capital. In most retail FX accounts, margin required for major pairs might be as low as 1 to 5%, leverage 20:1 to 100:1, depending on broker and regulation. While leverage magnifies potential profits, it equally magnifies potential losses. A modest adverse move of 50 pips on a highly leveraged position can wipe out a substantial portion of your equity. As one educational guide summarizes, leverage is an amplifier of both gains and losses. Prudent traders treat leverage as a tool, not a shortcut. They apply caps on how much of their total account equity is at risk and avoid using maximum available leverage until they possess strong process, risk controls, and psychological discipline. Page 4. Let's consider how spreads, pips, and leverage interact in a live trade scenario. Suppose you buy euro to US dollar at 1.1050, paying a spread of 1.2 pips. Set a stop loss 30 pips below entry and target 60 pips above. Your pip value per standard lot is roughly $10. Therefore, 1. Entry cost to the spread equals USD 12, 1.2 pips times $10. 2. Risk equals 30 pips times $10 equals $300. 3. Reward equals 60 pips times $10 equals 600 US dollars, risk reward 1:2. If you use leverage 50:1 and your margin deposit is 2,000 US dollars, controlling a 100,000 US dollars position, a 30 pip adverse move is 300 US dollars, 15% of margin. This illustrates how quickly losses impact capital under high leverage. Now imagine trading a less liquid exotic pair. Spread might widen to 5 or 10 pips. Pip values convert into another currency. Liquidity risk grows and slippage is likely. The cost and risk equation shifts. That's why many beginners focus on major pairs with tight spreads and stable pip values until they master mechanics. Key takeaways. Always assess spread in pips before entering. Always calculate pip value relative to your account currency. Always set risk in dollar or account base. Terms before considering position size and leverage. Page 5. To summarize, 1. Spread is your immediate cost of entering a trade, difference between bid and ask. Tighter spreads reduce drag on your strategy. 2. PIP is a standard measure of currency pair movement, enabling you to quantify stop losses, targets, and risk in a consistent unit. 3. Leverage gives you expanded exposure, but also expanded risk. When used without control, it can lead to rapid losses. For the beginner trader, here are practical rules. 1. Focus on major currency pairs during high liquidity sessions, so spreads are lowest and pip values clear. 2. Always compute pip value in your account currency and decide your maximum allowable loss in advance, e.g., risk less than or equal to 1 to 2% of equity. 3. Use moderate leverage that allows you to survive multiple losses without significant equity damage. 4. Regularly monitor if your broker's spread widens unexpectedly, e.g., during news releases, and avoid entering trades when spread/humidity is large. 5. Recognize that cost, spread, movement pips, and capital efficiency leverage interact dynamically. Managing the interplay differentiates disciplined traders from gambling novices. With this foundation set, you're now ready to move into the next chapter. Chapter 3, Market Sessions and Timing, where we examine how the 24-hour Forex market is structured and how to sync your trading rhythm with global liquidity flows. End of Chapter 2. And that brings us to the end of Chapter 2. Currency Pairs and Market Mechanics, from the audiobook Forex Trading Fundamentals, a complete beginner's guide. In this chapter, we explored how currencies are paired and priced, how to read exchange rate quotes, and how spreads, pips, and leverage all work together to shape every single trade. If you've made it this far, congratulations. You now understand the very structure of how Forex trading functions behind the scenes. Remember, true trading success begins with a solid foundation. By mastering these basics, you've already taken the first big step toward becoming a confident, informed trader. Up next, we move into Chapter 3, Market Sessions and Timing. In this chapter, I'll walk you through how the Forex market operates 24 hours a day across the globe, the unique characteristics of the London, New York, and Asian sessions, and the best times to trade depending on your lifestyle and chosen pairs. This next part is where timing meets opportunity, so you definitely don't want to miss it. Hello, if you haven't welcome already, back to the TheRockFXHub. Please subscribe to the TheRockFXHub, like this video. I'm Peter. And share it with anyone who's learning or to trade. As most of you know me. That way, you'll receive notifications the moment Chapter 3 goes live. And you'll continue growing with us step by step. Thank you so much for listening and for being part of the RockFX community. I'm Peter the Rock, and I'll see you in the next chapter. Until then, stay focused, trade wisely, and keep learning.